Did you know that just after the general elections results were declared in 2004, the Sensex dropped by 15.52% on 17th of May 2004. This is considered to be among the biggest ever drops in the Sensex. Did you know that between 2014 and 2024, the Sensex has grown nearly 4 times to 76,000? Hello and welcome to another edition of Capital Calculus. I am your host, Anil Padmanabhan. Earlier this week, the Sensex crossed a lifetime high of 76,000. However, the Sensex, which is a bellwether for stock market investors, failed to hold this peak. Since then, the Sensex has been moving up and down. What do we make of this? Is this the case of jitters before counting day, which is less than a week away? Or is it about investors cashing in on some profits at a very high level of the Sensex? Or is it that investors are reacting to other stimuli, particularly the fluid geopolitics with West Asia in focus? To answer all this and more, I spoke to Gaurav Dua. He is the head of strategy at Sharekhan. I began by asking Gaurav whether the pre-election results volatility was a cause for worry.
If you see, equity is never a straight line, right? You always have ups and downs. And after such a smart rally that we have seen, where small cap index has gone up by 70-75%, it's natural for the stock markets to slip into a consolidation range, take a breather, take a pause before it starts on an uptrend again. So I think slipping into this zone, consolidation zone, is actually this extremely healthy sign. But there is a part of the market where we are slightly concerned. What we see is that there is built up of speculative froth in the small cap space, micro cap space after a very, very strong rally. Some of these stocks are looking overvalued to us. A lot of investors are trying to chase these speculative stocks, momentum stocks. That's where I believe that there could be some pain if the stock markets turn much more say volatile.
So these speculative stocks you mentioned, how significant is their share in the total market cap? Are they so big that they could influence market sentiment?
So, if you have a look at the history in past 15, 20, 25 years, what we see is that there is a one-way small cap, micro cap rally, which lasts on an average from 17 to 18 months, followed by basically 1 to 1.5 years of pain. In that this painful period, corrective phase, the small cap index can go down by 30-35%. However, some of these individual stocks go down by 50, 60, 70, 80% also. And, and this thing, unfortunately, a lot of these small investors, retail investors, love to follow these stock, chase the momentum. So though they don't form a very large part of the market cap of the overall market, but there is a lot of interest which is there from the small investor, and they end up with a very, very bad experience.
Coming back to the volatility, we have seen a very distinct trend. It's basically the FIIs, the foreign investors who seem to be withdrawing from the market. Why are they hedging their bets?
So you have this very, very large event ahead, basically election outcome. So obviously there would be some kind of this profit taking that we are seeing from FI. There are multiple other things also. For example, you had this news about some hedge funds that had to be had to be this thing shut down. So there was some kind of this pressure from that side. Number third, there was this huge gap between the valuations of India and that of China. So, there was also this trade across the world, book some the same profits out of India, take that money to China. So there was multiple things which have led to some kind of withdrawal. However, at Sharekhan, we don't track FII flows on daily, weekly, monthly basis because that are going to be extremely volatile, and you can't form any trend out of that. What we do is we track net FII flows on a 12-month basis, rolling basis. If you say have a look at that trend went from positive onto the this thing, negative side in November 2021. And after 18 months, March 2023, it came from the negative side to the plus side. That means the entire selling pressure of 2022 was absorbed. And after that, for past more than a year, it has been in plus. So the 12-month basis, rolling basis, FIIs are still on a net inflow side and they are not on the outflow side.
Okay, coming to the domestic investor, we have seen that even when the withdrawals were happening in the short term, the domestic investors picking up the slack, which is why you crossed the peak of 75,000. So, what does it tell us about the domestic investor, both wholesale and retail?
So, it's been something which has happened, which I've seen over the years, is that there has been this growing awareness among the investors. They understand the importance of equity as an asset class now. A lot of investors want to have some exposure to equity. Uh, in the past, we have seen 10 years, or 12 years, 15 years back, a lot of investors used to enter the equity market for a very, 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 very short term trade. They wanted to play the rally and get out. But now, a lot of investors are there in the equity market for the long run. And I think a lot of this credit also goes to basically the awareness and uh, the this promotion of this SIPs. So that's this excellent tool which is there for the investors to basically invest into equity market in a very, very good way, gradual way. We also, as the full service as a broker, we do a lot of events online, offline, basically to educate the investor and show them that how equity is like one asset class which can uh, help you actually make wealth. Okay, and you are at a stage where this Indian economy is going to see a excellent time over next 5, 8, 10 years. And if you don't have exposure to equity at this point of time, you're going to basically this miss an opportunity of the lifetime.
So, what you're saying is that investors, domestic investors particularly, should stay locked in because they need to take advantage of the emerging growth process, right? I mean, the growth cycle that is expected to kick in.
So you are basically at the start of a multi-year upcycle in India. So if you see, no, say every economy has its upcycle. They also have its this thing down cycle. So in India, what we have seen in the past, there is 5 to 8 years of upcycle, and then there's this 8 to 10 years of a slowdown down cycle. So after the upcycle of this thing 2 to 8, basically 5, 6 years of upcycle that we had seen starting off 2002 to 8, we have like started to see that. So if you look at it in past 7, 8 years, basically Indian economy was largely supported by the increasing allocation for infrastructure development. But what is happening in past 2 years? what has actually changed is that you have started seeing a property upcycle. Real estate has a very huge impact on the economy, brings in jobs, brings in this wealth effect, brings in steel, cement, paint, tiles, basically engineering goods demand. So, and it is a 5 to 8 years of upcycle. Same way, after a very long gap, you are seeing private sector expansion cycle. So that again is going to help drive the growth in the economy. So with basically infrastructure standing, real estate upcycle, private sector expansion, all the drivers of growth in the economy are in place now. So if you want to take advantage of that, you will have to stay invested in equity market for that time period.
So, Gaurav, what is the evidence or signals you're getting on private investment kicking in at this stage?
So, if you look at all the large, basically, houses in India, Tata, Birla, JSW, Adani, Ambani's, they have anywhere between 40 to 60 billion dollars of expansion plan. And this expansion will not happen in a year, 2 year. When we also speak to the smaller companies, mid-sized companies, they are all talking about expansion. You look at any industry today, steel, cement, paints, again, core industries that I'm talking about, most of the larger mid-sized players are talking about expansion or started doing expansion, right? And this expansion cycle starts when the stress on the books of corporate India goes down. That is what we have seen in past 4 5 years. The debt equity ratio of corporate India has come down from about 1.1 to zero point 0.6 times. So the health of the this in corporate India is now much better. If you have a look at some of these spaces like basically, mining, metals, textile, all these were under stress this 4 to 5 years back. Now, most of these players have been able to bring down their debt and started to expand. On the other hand, what we have seen that the record high bad loans in the bank, where in March 2018, the banking industry in India was at around 11.9% of gross NPAs, that is bad loans, which has now come down substantially, and you are around 1.5, 1.6 this thing percent of net NPAs in the system. So on one hand, this thing, corporate India has become stronger. On the other hand, the banks, which have to play a very important role in the growth of any economy, now are in a shape will be able to help the fund the growth in the economy. So overall atmosphere or overall business environment is in place where basically corporate India can go on to that multi-year expansion cycle, and we can see all those signs on the ground now.
Yeah, but Gaurav, this healthy scenario has been flagged for at least 6 months now, but we are not seeing the investment take off. So, are you, as someone who's observing the market so closely, observing business so closely, seeing actual investment orders being placed?
So yes, we are starting to see that, but the effect on the ground takes some time. So if you take for example the sector, this is power sector, right? Now, power sector had some players like Bharat Heavy Electrical, BHEL. So BHEL in last 1 year has had record record order bookings. Okay, if you look at the statements from NTPC, the kind of order book district pipeline that they have, after a long time, 8 10 years, they are talking about a huge order book. They are going to talking about 2.5 lakh crore plus of orders that they're going to this thing give out over next year and a half, 2 years. So there is work going on. You can see basically orders have started to flow in. Those order execution will start happening now.
Now, coming to the big question, in less than a week from now, you will have the tallying of the general election votes. So, going by all the popular perceptions, we expect a third term for the incumbent government. Now, assume that doesn't happen. So, what is your outlook for the stock markets in either scenario?
So, if something happens, outcome is which is in law, which is not in line with the expectations, obviously it will have an impact on the market. But you need to go back in time. Take example from 2004. Even then, you had the expectation that this thing NDA will come back to power. Outcome was a surprise outcome. You had basically this thing, UPA back in power, coalition government again. A lot of statements were made by that government, which was basically not this thing supportive for the growth in the economy, was not as per the expectation of a market. Markets fell, and they fell very very sharply. But markets were back at a new high in 6 to 8 months. Okay, so basically what I'm saying is, if Modi or the NDA government does not come back into power, that will have an impact on the market. But as I said, there is a strength in the economy, this momentum in the economy. You are starting a multi-year upcycle. I don't think that is going to change in any big way, which can spoil the party in the equity market. So if it does happen, market falls because of NDA not being in power, I think that will be an opportunity for the investors, and it will not be a fall decline which is going to last for a long time.
Interesting. So, what you're saying is there will be a short term shock, but not a medium term impact. But tell me something that one of the big bets that the markets and investors are making is political stability. So, in case there is no continuity, we are looking at political instability. So, you believe the market sentiments will stay steady even if political instability arises?
So as I said, it will take some time. Political stability, as I said, wasn't there in '04 also, right? There was no one who had a clear mandate. That party coalition which came into power was had support of 12 odd distinct parties, if not more. So, but as I said, stability is something which the investors like. But as the new government will this thing come in place, you'll have some names which will be known. They'll have their background, credibility. Markets are going to come back. Okay, and as I said, apart from the short term distinct sentiments, markets are basically slave of the growth in the corporate earning, growth in the economy. And there is this strength in the economy, right? The real estate upcycle is never a distinct short term upcycle. Okay, when you have that upcycle, it's going to last for some time. If the private sector expansion has to happen, if there is shortage of this power supply, there'll be new plants which are going to be put in. So economy will grow, corporate India will grow, and stock markets will do well eventually.
One point I'll beg to differ is the size of the economy. In 2004, it was about 400 to 500 billion. Today, it is 3.7 trillion. The stakes are much, much bigger today than it was, say, 20 years ago. And also, the geopolitics is so fluid. India's neighborhood is a minefield. And which is why political stability is critical for continuity of foreign policy and domestic policy. So you are not perturbed that these are big risks that could rock market sentiment.
So, you'll always have risk in the market. You will never have a time when you don't have any kind of risk. So if I can go back to time again and explain you with an example, hard facts. If you look at last 8 years, 2016 to end of 2023, in that 8 years you have had a lot of events. Every year you had a very distinct major event. 2016 you started with something known as demonetization. Then you had implementation of goods and services tax, which have been implemented and in this is some of these places and had basically adversely impacted the economy for next this 2 to 4 years. You had the record high bad loans in this banking system. You had the this ILFS fiasco and the issues in the NBFC. You had the once in basically 100 years of lockdown pandemic. You had the war and the supply side issues across the world. You had 40 years high inflation in the world, followed by the most aggressive interest rate hikes in India, Europe, and US. You had a war again. So there is everything that could have gone wrong in India and the world did happen. And you'll be shocked to know that out of those 8 years, 7 years market ended in the green. From the 1st January to the end of the year, you had excellent gains. So it's only 2018 when Nifty was actually down marginally by 4 to 5%. And you had 15% CAGR growth in Nifty. So if you have invested 100 rupees, that would have become in that 8 years uh, is 3.2 times. And if you had picked the right kind of stocks, they could have made your money 4 times, 4.5 times, 5 times also. So in that phase, where the only support to the economy was spending on the infrastructure or the increasing allocation in the infrastructure, and you had a major event which could adversely affect the economy and the stock markets, still you had a very healthy gain, right? And now you are starting on a multi-year upcycle in economy. So even if you have some instability or you have certain new issues in the world, I think what equity markets can offer you from here could be much higher than what you have seen in last 8 years.
You heard Gaurav. He's very sanguine about the future of the stock market. According to him, even if the results go against the broad expectations, the market will recover after the first shock. According to him, the economics trumps the politics. Basically, India's economic future is so bright that it will absorb any political instability that may occur. In short, the show must go on. Thank you for watching. Don't forget to subscribe to StratNews Global on YouTube. Hit the bell icon so that you don't miss any updates. And please do share your thoughts, ideas, and suggestions with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.